Best Sense Market Commentary for the second week of October 2025. And actually, we've got a little bit more to talk about. As we've said, it's been an inexorable rise up incrementally every week, a few percent up for most markets, mostly in unison for the last few months. But then there seems to be a few cracks appearing in markets composure. And we saw this happen for quite disparate reasons. Last Friday, Trump doubled down on China, threatened imposing 100% tariffs on certain products, and markets took fright at that. Now, interestingly, it was the tech stocks which were the most affected, the Nasdaq down by almost 4%, but global small caps ex-US, Australia, UK, Europe, not moving that much, and even emerging markets, including China, and it was mainly coming from China, the rest of the emerging markets, pretty sanguine. So it does seem it's not just about the facts, the fundamentals. Sentiment is important, high valuations, people a little bit edgy. And that brought us on to what brought the big rebound. Well, first of all, there was a little bit of a rebound on Monday as both sides walked back some of those comments. Actually, Xi Jinping may have doubled down a little bit again overnight. So there's just a lot of noise around that stuff. Predictions markets suggesting very little chance that either side will actually follow through and that there'll be some kind of agreement. So there's obviously scope for disappointment there and a little bit of uncertainty. But again, what's interesting, on a very different tack, overnight, Jerome Powell, having been a little bit more worried about sticky inflation, started to make noises about a slowing labour market, and it was the Russell 2000 that was up by more than 4%, which is US small caps. So again, not really in line. If you're worried about a recession and a slowing economy, that might not be the one that you'd expect to jump the most. But as you can see on the chart there, by far the biggest mover, which again points to a lot of liquidity. There's a lot of, for instance, profitless tech, even revenueless tech in that universe as well. So this seems to be about jumpy markets more than anything you can really point at from a fundamental factor, at least how it's coming out in markets. Now, interest rates have been reasonably calm. You can see this. That was just a 10 basis point move downwards in expectations in markets for sometime early next year. And that seems to have moved markets to some degree. And if you look at how that looks on the Fed's dot plot, you can see that there's quite a wide variance. Right down the bottom, you've got Trump's man thinking by 2027 we'll have rates down below 2.5%, and other members of the committee up around 4%. Now, if you look at that green bar, that's the median. And if you look at the where most of the dots are, it actually follows that to a larger extent. But what's interesting is the purple line, which is the market implied one, which is what we've just been looking at the previous slide, and that's actually quite a bit below. So there is scope for markets to be disappointed here, and these are relatively small moves. You suspect that something is going to overshadow that. Either we're going to see more buoyancy in the economy or more strength than expected, or we're going to see more of a slowing, and that'll probably move a little bit, but it gives you a sense that even small moves in expectations are having a big impact. And the other thing around expectations, which is really coming to the fore this week and into the next few weeks, is the US reporting season. Now, the background for that is that we have seen very strong tech earnings, slightly more moribund the rest of the US economy, but ahead of expectations, as they usually are. But there is signs of deceleration, although earnings expectations have actually risen just in the few weeks prior to reporting season, and normally it goes the other way as people sort of moderate their expectations. So there is sort of signs of resilience, but as we saw overnight from JP Morgan, it might be more about the guidance, because again, a lot of these results are looking backwards, still during this sort of front-loading era where there's been a lot of activity getting ahead of the tariffs, and we might be in a little bit of a slack zone. So people are particularly interested in what CEOs think about the future. And Jamie Dimon of JP Morgan reported outstanding profits, record, etc. However, he talked about the provisioning they were doing for credit losses that they can see down the pipe, and some of them which they're already seeing, including one of those bankruptcies, I think it was Tricolor, that they were exposed to the tune of 150 million. So the market's a little bit edgy about that, even though the strength of the cash flows is so strong. And that might be a little bit of an emblem to look out for versus expectations. But as you can see on this chart, The expectations for tech earnings still very strong. That's driving the US economy. Again, scope for disappointment, but it could go anywhere, especially if there's some signs of some kind of return on investment with some of this AI infrastructure. That would really get the animal spirits going. But on the other hand, if you don't see that, or if you see increased spend and no signs of it becoming profitable, then markets might be disappointed by that. So notwithstanding everything that's happening geopolitically and with the tariffs and with rate expectations, for the next few weeks it's highly probable that markets will be scrutinizing US corporate results to a very great degree, and we look forward to talking a little bit more about that next week. Thank you. Bye.